Okay, let me start with a question that might sound crazy. Why is the stock market celebrating a recovery when the economy still feels like it's teetering on a knife's edge? Because that's exactly what's happening here. Nasdaq futures are up, Amazon just had a 9% surge after earnings, and Microsoft's cloud growth is lighting up Twitter feeds. But hang on, just 24 hours earlier, the Dow plunged over 1,000 points. What's going on? Let's unpack this roller coaster ride. First, Amazon's earnings report. The company crushed Q2 expectations, but here's the kicker. It wasn't just about holiday sales or Prime Day hype. The real story is AWS, their cloud division, propping up the entire tech ecosystem. Every AI startup, every hyped-up generative model, every metaverse company needs cloud infrastructure. Amazon isn't just a retailer anymore. It's the plumbing of the digital economy. Personally, I think this earnings pop reveals a deeper truth. Investors aren't betting on Amazon's products. They're betting on the demand for AI. But is that sustainable? Or are we just seeing a delayed reaction to the AI hype cycle? Then there's Apple. iPhone sales jumped 22%, which sounds great until you realize their services division, the supposed recession-proof cash cow, missed targets. Let that sink in. Even Apple, the king of ecosystem lock-in, can't force users to pay for subscriptions. What does this say about consumer spending? My take? People are prioritizing hardware upgrades over recurring costs. Maybe they're tired of endless subscription fees. Or maybe the digital wallet revolution is hitting a wall. Either way, Apple's stumble shows cracks in tech's services-first narrative. Now let's talk about Microsoft. Their Azure growth sparked a 16% stock jump, which then dragged semiconductor ETFs up 8%. Classic domino effect. But here's what fascinates me. The market isn't rewarding innovation. It's rewarding predictability. Microsoft isn't doing anything new. They're just doing the basics better than rivals. In my opinion, this signals a shift from hype-driven momentum to show-me-the-numbers fundamentals. The Magnificent Seven aren't invincible anymore. Investors are getting pickier. Which brings me to the Federal. They held rates steady, and suddenly everyone's panicking about inflation. But wait, the real issue isn't inflation itself. It's the fact that rate cuts aren't coming soon. That liquidity spigot that's kept markets buoyant since 2023 is slowly closing. One thing I find fascinating is how this mirrors 2022's crash, but with a twist. Back then, the Fed was hiking rates. Now, they're just not cutting. Markets have become addicted to stimulus, and even a pause feels like withdrawal. And let's not ignore the elephant in the room. Retail investors. For 25 straight weeks, individual traders have been bearish. 25 weeks. That's longer than most TikTok trends. These aren't the YOLO traders of 2021. They're cautious, skeptical, and maybe even wiser. But here's the paradox. Their pessimism isn't dragging markets down. Why? Because institutional money is calling the shots now. The game's rules are changing. So what's the bigger picture here? Volatility isn't a bug. It's the new operating system. The market isn't reacting to news. It's reacting to narratives. Amazon's cloud dominance, Apple's services struggles, Microsoft's cloud growth. They're all pieces of a larger puzzle. What's the pattern? Tech is still the engine of the economy, but the road ahead is bumpy. AI promises to revolutionize everything, but can it deliver? The Fed's inaction is creating a liquidity squeeze, but are fundamentals strong enough to pick up the slack? Let me leave you with this. The Nasdaq's bounce might feel like hope, but it's really a gamble. A bet that AI will keep growing, that geopolitical tensions won't spiral, and that consumers will keep spending. If any of those cracks, watch the whole thing unravel. So what do you think? Is this rally the start of something real, or just another fake out? Let me know in the comments.